Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. Imagine you're watching a massive tech stock, right? One that's been totally dominating the headlines for the past year.
Right, the kind everyone is talking about at the water cooler.
Exactly. And
Yeah.
suddenly it drops 20% in a single week. So you jump in, you are totally convinced that you just snagged the ultimate bargain.
Oh, I've seen that happen so many times.
Yeah, but then 6 months later, you realize you just paid a premium for a totally dying narrative. So for today's deep dive, we are completely dismantling that clearance rack mentality because it is actively destroying portfolios in this 2026 AI market.
It really is. That clearance rack mindset is arguably the single largest destroyer of capital right now. The mechanics of the market have fundamentally rewired themselves over the last few years.
But people are still playing by the old rules, right?
Right. Yeah, exactly.
Yeah.
A shocking number of investors are still using this decades-old playbook to try and navigate a completely new environment.
Which brings us to the real mission of our deep dive today. We're looking at recent analysis to redefine what value investing actually means today. Because, true value isn't just about finding a cheap stock.
No, definitely not.
It's about pinpointing the exact moment where the market's collective expectations are just mathematically flawed.
That's the perfect way to look at it, because a stock price is not just a static number on a screen. It's really a highly compressed reflection of what the market expects for the future cash flows of a business.
Okay, so it's all about expectations.
Right. And if you misunderstand what those expectations are, well, you are basically flying blind.
So to understand how those expectations are priced, we really have to look at the traditional PE ratio, right? The price to earnings ratio.
Yeah, the classic metric.
Because the instinct, even for seasoned investors, is to screen for low PE multiples and just assume they've found a built-in margin of safety.
Right. They see a low number and think it's safe.
Like, let's say you see a legacy manufacturing stock trading at 8 times earnings. As a beginner, my cognitive reflex is to treat it like a slightly dented used car.
A dented used car. That's a great analogy.
Yeah, sure, it's not glamorous, it has some miles on it, but it runs perfectly fine, and it's half the price of everything else on the lot.
Yeah.
So the temptation to just buy it is huge.
It is huge, but that assumption relies on a totally static view of the macroeconomic world. The problem with looking at an 8 multiple today is that you are viewing a snapshot of past performance.
Right, it's looking in the rearview mirror.
Exactly. The market is not some charity offering you a discount out of the goodness of its heart. It is a highly efficient pricing mechanism, and it is actively discounting severe structural decay.
So a low PE isn't necessarily the answer.
No, a low PE isn't an answer at all. It's actually a question. It's a glaring warning sign. You have to ask, why is it so low?
And in the context of 2026, with President Trump currently in office, that structural decay is highly measurable.
Oh, absolutely.
If you are analyzing a traditional industrial supplier, that low PE is pricing in a completely new reality. We're talking about aggressive new trade dynamics, rising domestic energy costs, and the looming impact of incoming carbon regulations.
Yeah, let's break down the actual mechanics of how those policies compress margins, because that is what actually destroys the value of a stock.
Okay, lay it out for us.
Well, if a manufacturing company relies on a supply chain that is heavily rooted in China and a new tariff structure is implemented, they can't simply pass a 40% cost increase onto the American consumer.
Right, because nobody would buy their products anymore. It would completely crush their own demand.
Precisely. So they are forced to absorb that extra cost on their own balance sheet.
Which means their operating margins just shrink dramatically overnight.
Exactly. They go from a healthy, say, 15% profit margin to fighting for a 3% margin.
Yeah.
Suddenly, those past earnings that you based your cheap valuation on, they're entirely irrelevant.
Wow, yeah, because the future cash flow is basically vanishing before your eyes.
Right. So if a company is in structural decline, it isn't a value play. It is a value trap. You are buying equity in a business that is mathematically shrinking.
So the absolute key takeaway for you listening here is that you must always ask why the market believes that low price is justified. The price looks low, but the underlying intrinsic value is dropping even faster.
That is the perfect way to phrase it. You aren't buying a discount, you are catching a falling knife.
And that explains the low-end value traps perfectly. But the inverse of this, which is where I think even more capital gets incinerated, is when a high-flying, expensive sector suddenly takes a massive hit.
Oh, the tech sell-offs.
Yeah, we have fresh data from Reuters on July 2nd, 2026. The U.S. SOX Semiconductor Index dropped about 6% in a matter of days.
A pretty sharp drop.
Very sharp. And it was mostly cited as profit-taking and portfolio rebalancing, while the broader S&P 500 actually held totally steady.
And the immediate reaction from the retail crowd is invariably, oh, it's on sale, time to buy the dip.
Right, exactly.
Which is just a lethal application of anchoring bias in a modern context.
It really is incredible how stubborn that psychological anchor is. I mean, if an AI darling was trading at $200 a share last month, our brains just permanently log $200 as the correct intrinsic value.
Yeah, we get stuck on that number.
So when it slides to $160, the cognitive reflex is that we are somehow owed that $40 recovery. We treat the past price as a guarantee rather than just a historical print on a chart.
It is a totally devastating cognitive flaw. But let's move past the psychology for a second and look at the actual mechanisms driving that 6% SOX drop you mentioned.
Okay, what was actually happening under the hood?
Well, it wasn't a random markdown or a temporary glitch. Institutional money is aggressively questioning the structural risks and the math behind these massive AI capital expenditures.
I'm so glad you brought up the CapEx, because we were talking about hundreds of billions of dollars being poured into data centers right now.
Massive amounts of money.
And the market is looking at that spending and asking a very basic question like, when does the software monetization actually arrive to justify this infrastructure build-out?
Right. Where is the return on this massive investment?
Because you can't just keep building massive server farms if the enterprise software side isn't generating the recurring revenue to, cover the depreciation of those servers.
Exactly. I mean, NVIDIA's massive revenue is someone else's massive capital expenditure. And at some point, those buyers need to show an ROI.
Right.
Add to that the very real fear of memory chip oversupply that we're starting to see in the supply chain data, plus the fact that the Federal Reserve has kept the path of interest rates highly, highly uncertain.
Which completely alters the discounted cash flow valuation models. I mean, if the Fed keeps rates higher for longer, the cost of capital just remains elevated.
Exactly. It acts like gravity on stock prices.
Right, meaning those massive future AI profits are mathematically worth less today. So that $160 price tag isn't a 20% discount.
Yeah.
It is the market correctly repricing the stock based on a higher risk premium and delayed profitability.
That is exactly right. Past prices are historical facts. They are not baselines for future value.
And that anchoring bias is exactly why retail investors get crushed when institutional money shifts. Because while the average trader is looking at a 20% discount, the massive funds are looking at sector caps and liquidity constraints.
Which brings us to the sheer volume of capital dictating these moves.
Yeah, let's look at the numbers. According to Financial News London, global AI and robotics funds saw a staggering 280% surge in inflows in early 2026.
A 280% surge. That is just astronomical.
They pulled in $14.2 billion by late May alone, pushing total AI fund assets to $136 billion.
See, that is a wall of money that completely distorts traditional price discovery.
Yeah.
A massive inflow like that proves the structural growth trend is real, right? Nobody commits $136 billion to a fleeting fad.
Right. The technology is obviously real.
But simultaneously, it is a giant warning sign of extreme overcrowding.
And we saw the whiplash of that overcrowding almost immediately. Reuters reported on July 1st that foreign investors dumped Asian stocks at a record pace in the first half of 2026.
Yeah, I remember seeing that data.
They yanked $70.8 billion out of South Korea and $29.6 billion out of Taiwan. And their primary reason? Overcrowded portfolios in the semiconductor space.
This duality tells us everything about how modern markets function. When you see over $100 billion flee Taiwan and South Korea, you have to separate the underlying business from the mechanics of institutional portfolio management.
Right, because those funds didn't sell because the company suddenly forgot how to manufacture silicon.
Exactly. It's not about the business failing.
Let's dig into that mechanism, actually. Because a lot of people see an outflow of that magnitude and panic. They just assume the entire AI thesis is dead. But it's actually about forced algorithmic selling, isn't it?
It absolutely is. Think about it like this. If a massive institutional fund has a strict mandate that technology cannot exceed 30% of their total portfolio.
Okay, a strict 30% cap.
Right, and then these semiconductor stocks double in value because of the massive rally, well, suddenly tech balloons to 45% of our holdings.
Oh, I see. So they are now at a breach of their own risk compliance rules.
That is the exact mechanism. The portfolio managers don't necessarily want to sell the stock. They might still love the company, but their risk management algorithms are forcing them to trim their massive winners simply to rebalance back down to that 30% threshold.
Which just creates immense indiscriminate selling pressure across the entire geographic region.
Exactly.
So as an investor trying to navigate this, value investing means neither blindly following the herd, nor betting against them just to be contrarian.
No, it's about being analytical.
The real edge is analyzing why the crowd is moving, recognizing that a $100 billion sell-off isn't an indictment of a company's future cash flow, but rather the violent mechanics of funds just cleaning up their balance sheets.
Yes, you have to wait for their extreme optimism to turn into mechanical panic. The market can be incredibly irrational in the short term, driven by this herd mentality and algorithmic compliance.
But in the long term,
In the long term, it always reverts to reflecting the actual cash flow of the businesses. The true value investor lives in that time gap.
which fundamentally changes how we should evaluate so-called expensive stocks.
Right.
I mean, if overcrowded trades create distortions on the downside, what happens on the upside?
That's the billion-dollar question.
Because if I see an AI infrastructure stock with a PE of 30 or 40, the instinct is to just label it a bubble and walk away.
Which is what a lot of people do.
But recent analysis from Business Insider, citing Morgan Stanley, actually argues that these high multiples contain very specific, calculated expectations, because the true bottleneck for AI has completely shifted.
That is a crucial insight. The market has moved past the initial phase of the AI boom.
Right.
Like 2 years ago, the only thing that mattered was who could design and procure the actual AI processing chips. But now the constraint isn't silicon. The bottleneck has violently shifted to power infrastructure, advanced memory architecture, supply chain logistics, and software monetization.
Right, because you can have all the advanced chips in the world, but if you don't have the electricity and the transformers to connect your gigawatt data center to the grid, those chips are just incredibly expensive paperweights.
Exactly. It's like having a sports car with no gas station for 1,000 miles. So, a company involved in building industrial-scale liquid cooling systems, or one that manufactures high-voltage transformers, might command a PE of 40 right now.
And someone looking at traditional metrics sees that 40 multiple and just screams, overvalued.
Right, but the real value in that high-priced company isn't its current quarterly profit.
It's the monopolistic lock-in, right?
Yeah.
The mechanics of the utility grid and data center architecture mean you can't just spin up a competitor overnight.
Not at all.
There are massive capital requirements, crazy regulatory hurdles, and multi-year contract backlogs. If a company controls the specific cooling technology required for a new $5 billion hyperscaler facility, they possess immense pricing power.
Precisely. Once a hyperscaler integrates that proprietary architecture, they aren't going to rip it all out just to save a few pennies with a competitor next year. The switching costs are absolutely catastrophic.
So they basically have future data dominance and absolute customer lock-in.
Yeah, they do.
So the job of the investor isn't to just dismiss the high price out of hand. Your job is to stress test the market's expectations. You look at that PE of 40 and ask, what specific future is the market buying at this price?
Exactly.
And what are the realistic chances that this future actually materializes? If the expectation relies on flawless execution with zero competition, then yeah, it's a bubble.
Yep.
But if they have a multi-year, legally binding backlog of contracts,
then it might actually be reasonably priced, if not deeply undervalued. Modern value investing requires evaluating whether a company has the structural moats to guarantee the cash flow required to justify that premium.
that is just a phenomenal way to reframe valuation. But let's operationalize this for our listeners, because Reuters recently reported that BlackRock has noted the current environment is actually a perfect setup for active investing.
Oh, absolutely it is.
The AI rally is maturing, and the hunt for value has moved to these less appreciated sectors. But looking at macro trends and portfolio rebalancing is great theory. We need a concrete framework to execute this.
Well, based on the research and the current market dynamics, there is a very clear 3-step playbook for this exact environment.
Okay, let's go through it. Step 1.
The first step is deconstructing the multiple through a macroeconomic lens. You cannot analyze a stock's valuation without explicitly mapping it against the Federal Reserve's rate path.
Right, which ties perfectly back to that Reuters data from July 2nd. The market was incredibly mixed specifically because of conflicting jobs data and uncertainty around what the Fed will do next.
Yes, we have to factor in the equity risk premium. If the risk-free rate on a treasury bond remains elevated, the mathematical hurdle for a company's future earnings to justify its current price is vastly higher.
Exactly. I mean, a PE of 20 in a zero interest rate environment is a completely different asset than a PE of 20 when rates are sitting at 5%.
Totally different. When you deconstruct the multiple, you are recalculating the present value of those future earnings using today's cost of capital.
But wait, adjusting for the macro cost of capital only tells us the environmental side of the equation. What about the actual business performance? Because Wall Street price targets are just notoriously reactionary. What metrics actually give us a better picture of the underlying business?
And that brings us to step 2, which is estimate momentum. You are entirely correct to ignore Wall Street price targets.
Yeah, they just follow the price up and down.
Exactly. What you actually want to look at are the raw earnings estimates, the sell-side analysts who actually model the supply chain, the order backlogs, and the operating margins. You want to look for the inflection points in those estimates.
So let me make sure I have this straight. If a stock's price is dropping because it's caught up in one of those massive Asian tech outflows we discussed earlier.
Right, the forced selling.
Yeah, but the fundamental earnings estimates for the next 3 quarters are steadily being revised upward. You have essentially found a massive dislocation.
Yes. It's the divergence between the stock price and the business reality. The price is plummeting due to forced algorithmic selling, but the underlying cash generation of the business is actually accelerating.
And that is the definition of a margin of safety in 2026.
It truly is.
Which leads perfectly into the third and final step of the playbook, following the institutional footprint. Because you can identify the greatest fundamental setup in the world, right? Rising earnings estimates, a reasonable multiple.
Yeah.
But if a sovereign wealth fund or a massive ETF is in the middle of liquidating a $30 billion position, your fundamental analysis will get absolutely bulldozed.
Without a doubt, you cannot stand in front of a $70 billion outflow and just wave a spreadsheet. You will get crushed.
So how do you time it then?
You watch the daily trading volume. You wait for the massive red selling days to shrink, and you wait for the stock to start consolidating sideways despite bad macroeconomic headlines.
Ah, so that's your signal that the weak hands are fleshed out and the forced institutional selling is exhausted.
Exactly. That is the execution phase. You wait for the mechanical selling to end, you verify that the earnings estimates are rising, and you ensure the valuation makes mathematical sense in the current interest rate environment.
That is an incredibly robust, actionable framework. So to sum up this deep dive, true value investing in 2026 is light years away from just buying a stock because the price chart went down.
Far from it.
It is a rigorous forensic exercise. It's about deconstructing the mechanics of how terrorists compress margins, understanding how institutional compliance rules create these artificial sell-offs, and calculating whether a company has the monopolistic lock-in to justify a premium multiple.
It really requires stripping away the emotional comfort of low numbers and replacing it with a structural analysis of future cash flows.
As we wrap up, what is one final thought you can leave with our listeners to, stress test their own portfolios today?
I'd challenge you with this. Next time you look at your highest conviction stock, play the role of the aggressive short seller.
Oh, I like that.
Ask yourself, what is the single most structurally devastating argument against your thesis? Does an unexpected tariff instantly crush their supply chain margins? Does an AI architecture shift render their core product obsolete? If you cannot articulate the exact mechanism that would destroy your investment, you aren't analyzing. You are just hoping.
A brutal but absolutely necessary test. That is all the time we have for today. Don't forget to subscribe and hit that like button.